Our next guest says many investors mistakenly put their bond portfolios on holiday for the summer when they go away as well. But he says now is the time to think about fixed income allocations. Joining us is David Fry, Managing Partner and CEO at Lawrence Park Capital Partners. Good morning, David.
Good morning.
People probably put their whole portfolio on hold for the summer because they're too busy barbecuing and having fun. Fixed income portfolios specifically, though, what should they be thinking about in terms of allocation?
Yeah, I think it's important to think about what we're seeing now in terms of interest rate levels, in terms of volatility, in terms of macro events, which are driving a lot of fundamental change in the way that people should be allocating and looking at both passive and active management in fixed income. So right now we've got, I think, a great opportunity for investors, for advisors, to look back at their fixed income, to think about why they're invested in fixed income, to think about the objectives that they're trying to achieve, things like capital preservation, low volatility, and income, and take a look at their fixed income portfolio and see, is this actually delivering what I hope it will? And I think invariably, if people actually go through that exercise now, they're going to find out that it's not achieving those objectives.
Well, why not? Well, actually, there are a couple of questions. For a lot of people, they hope the fixed income part of their portfolio is what they don't have to think about ever. Oh, okay, give me some 10-year Canadian government bonds and call me around Christmas time and tell me how good I've done. Is this really a case of the volatility that we're seeing in this particular market right now? Are you having to be more active with how you're managing money now, say this year, than you were a few years ago?
Absolutely. I think that the volatility bodes for more active thought process and active management for fixed income. We've got 10-year government bonds, as you mentioned, at sub-170 levels. What that means really is that if we see a 30 basis point rise in 10-year government bonds, we wipe out 12 months of returns of DEX index. And the bulk of what people invest in Canada, long-only fixed income, is in DEX index funds. So that's the combination of the yield levels that we're seeing now and what that means from the bond math in terms of rate rises and how that can erase any potential coupon really that you're getting.
There has been a worry about this, I hate to say it, like once a quarter for the past 5 years. Every time people say, okay, your asset allocation, your overweight bonds because they've done so well, take a little out, put it into the equity market. And it works, it seems to have worked for a month. And then things turn around and bond yields go to lower and lower and lower levels. Is this the time?
Well, I think it's about diversification. So this isn't really about trying to gauge or make a bet on whether interest rates are going higher or lower. It's about looking at your portfolio and going back to that set of objectives and seeing whether, if we think about what's going to happen going forward, is this going to achieve what I want out of it? And thinking about, should I be diversifying away from interest rate strategies or strategies like we've seen the last 30 years? Investing in fixed income in the last 30 years has been take a holiday, invest, put your money in and go on holiday, and you'll come back in a year's time and have 12 to 15% returns. Well, those days sadly are probably over, and that bodes for at least a thought process or a thinking about diversifying fixed income strategies away from interest rate sensitive strategies.
So how are you diversifying the money that's under management at Lawrence Park?
So the first thing that we do is hedge out interest rate risk. So we break down the fundamental components of a corporate bond into credit and interest rate, and we buy a bond and we hedge out the interest rate risk. So we immunize that bond or a portfolio of those bonds from interest rate risk.
How do you do that?
We short a government bond. Okay. We might pay on an interest rate swap. And beyond that, if we're buying bonds outside of Canada, we also immunize the FX risk. So we can buy cheap bonds in the U.S., hedge them back to Canadian dollars, so we eliminate the FX risk as well. And then we'll look at the credit component and decide whether there's something intrinsic about that we might want to hedge away in terms of specific risk or market credit risk. And then we'll look to optimize a portfolio of those bonds from Canada, from the U.S., selectively, very selectively right now in Europe, in combination, and create a portfolio of low volatility assets.
It strikes me, so you're hedging out your FX risk, you're hedging out your interest rate risk, and you're hopefully left with this credit that's going to give you some upside. But what are the costs of that? Even in the corporate bond world, interest rates are pretty low.
Right.
What are you going to be left with after you do this hedge and that hedge?
Great question. I think we get asked that question a lot. And so if you're just to do that in a pretty passive way, if you're to buy, a Bell Canada 7-year bond that might yield 3%, hedge away the government, the interest rate risk for 1.5%. It's pretty simple math. You're left with 1.5%. And if that's all you did, then that's 1.5%. That's not really going to get anybody excited. So you really need to look at you need to look at dislocations in the fixed income markets, which is, you know, as we heard in a speech recently from ex-Bank of Canada Governor David Dodge, fixed income markets are 15 times the size of global equity markets. They're over the counter. There's a lot of information asymmetry. So there's a lot of dislocations and inefficiencies there. So we're looking at bonds that trade cheap and looking at hedging them with bonds that are expensive, and not really looking at that relationship to stay the same. We're looking at that to converge. And that's how we make total returns and low volatility returns in the portfolio.
David, great to have you back. Thanks for joining us.
Thank you.
We're joined by David Fry. He's the managing partner and CEO of Lawrence Park Capital Partners.
Up next.